Mortgage lending is slowing, and banks are tightening their underwriting standards still further. So what does this tell us about the trajectory of home prices and the risks currently in the system? Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 30th September 2017. We start our review of the week's finance and property news with the latest lending data from the regulators. According to the RBA, overall housing credit rose 0.5% in August and 6.6% for the year. Personal credit fell again, down 0.2% and down 1.1% on the 12-month basis. And business credit also rose 0.5% or 4.5% on an annual basis. Owner-occupied lending was up 17.5 billion, 0.68%, and investment lending was up 0.8 billion at 0.14%. Credit for housing, that's owner-occupied and investor together, grew as a proportion of all lending. The RBA said the switching between owner-occupied and investment lending is now 58 billion from July 2015, of which 1.7 billion occurred the last month. These changes are incorporated in their growth rates. On the other hand, data on the banks from APRA tells a different story. Overall, the value of their mortgage portfolios fell 0.11% to 1.57 trillion. Within that, owner-occupied lending rose 0.1% to 1.02 trillion, whilst investment lending fell 0.54% to 550 billion. As a result, the proportion of loans for investment purposes fell to 34.9%. This explains all the discounts and special offers we've been tracking in the past few weeks, as banks become more desperate to grow their books in a falling market. Portfolio movements across the banks were quite marked, with Westpac and NAB growing their investment lending, while CBA and ANZ cut theirs. But this may include loan switching between categories. Remember that if banks are able to switch loans to owner-occupied categories, they create more capacity to lend for investment purposes. So putting the two data sets together, we can also conclude that the non-bank sector is also taking up some of the slack. Our mortgage stress data got a good run this week, with the AFR featuring our analysis of affluent stress. More than 30,000 households in the nation's wealthiest suburbs are facing financial stress, with hundreds risking default over the next 12 months because of soaring debts and static incomes. This includes blue ribbon postcodes like Brighton and Glen Iris in Victoria, Mosman and Vaucluse in New South Wales, and Netherlands and Claremont in Western Australia. The RBA is worrying about household debt from a financial stability perspective, according to Assistant Governor Michelle Bullock. She said households have really high debt, and mainly mortgages, as a result of low interest rates and rising house prices, and especially the impact of interest-only loans. High levels of debt does leave households vulnerable to shocks, she said. The debt-to-income ratio is rising, it's 150%, but for some it's much, much higher. We will release our September stress update this coming week. Debt continues to remain an issue. For example, new data from the Australian Financial Security Authority shows that in 2006-17, the most common non-business related cause of debtors entering personal insolvencies was the excess use of credit, followed by unemployment or loss of income, and then domestic discord or relationship breakdown. However, employment-related issues figured first in Western Australia and South Australia. It's also worth saying that the Bank of England has now signalled that the UK cash rate will rise, and this follows recent statements from the Fed in the same vein. So it's increasingly clear that moves to lift rates will raise international funding costs to banks and put more pressure on the RBA to follow suit. Meantime, lenders continue to tighten their underwriting standards. ANZ announced that it will be implementing new restrictions on some loans for residential apartment units and flats in Brisbane and Perth. Now there will be a maximum 80% loan-to-value ratio for owner-occupied and investment loans for all apartments in certain inner-city postcodes. We think these changes reflect concerns about elevated risks due to oversupply and price falls. ANZ's policy changes apply to all apartments in affected postcodes, including off-the-plan and non-standard small residential properties, valued at below $3 million. Good news though, granny flats are excluded. More generally, ANZ also issued a customer interview guide with specific topics that brokers should discuss with home and investment borrowers. We expect brokers to use a customer interview guide to record customer conversations as a minimum moving forward, said the ANZ. While it is not required to submit the guide with the application, it should be made available when requested as a part of the qualitative file reviews. CBA launched an interest-only simulator to help brokers show customers the differences between interest-only and principal and interest repayments, and a new compulsory customer acknowledgement form to be submitted with all home loan applications that have interest-only payments to ensure that these payments meet customers' needs. CBA said that brokers must complete the simulator for all customers who are considering interest-only payments, irrespective of whether the customer chooses to proceed with them or not. These requirements will be mandatory for all brokers and will become effective on Monday, the 9th of October. Suncorp announced it is introducing new pricing methodologies for interest-only home lending. Variable interest rates on existing owner-occupied interest-only rates will increase by 10 basis points, and variable interest rates on all investor interest-only rates will increase by 38 basis points, both effective 1 November 2017. But what about property demand and supply? Well, the ABS said Australia's population grew by 1.6% during the year to the 31st of March 2017. Natural increase and net overseas migration contributed 36.6% and 59.6% respectively. In fact, all states and territories recorded positive population growth in that year. But Victoria recorded the highest growth rate at 2.4%, and the Northern Territory recorded the lowest growth rate at 0.1%. Significantly, Victoria, the state with the highest growth rate, is currently seeing the strongest auction clearance rates, strong demand, and home price growth. This is not a surprise given the high migration, and this may put a floor on potential property price falls. On the other hand, we also see an imbalance between those seeking to trade up and those looking to trade down, according to our research. Those trading up are driven by the expectations of greater capital growth at 42%, for more space 27%, and for lifestyle changes 14% and job changes 11%. Those seeking to trade down are driven by the desire to release capital requirement at 37%, to move to a place which is more convenient, that's either location or for easier maintenance at 31%, or a desire to switch to or invest in an investment property at 18%. Now, in the past, we saw a relative balance between those seeking to trade up and those seeking to trade down. But this is now changing. Intention to transact highlights that relatively more down traders are expecting to transact in the next year compared with up traders. Given that there are around 1.2 million down traders and around 800,000 up traders, we think there will be more seeking to sell than buyers able to buy. And as a result, this will provide a further drag on future price growth, especially in the middle and upper segments of the market, where first-time buyers are less likely to transact. This simple demand-supply curve provides another reason why prices may soon pass their peaks. Up traders have more reason to delay, while down traders are seeking to extract capital, and as a result, they have more of a burning platform. Finally, auction clearance rates were still quite firm, despite the fact that property price growth continues to ease, and time on market indicators suggest a shift in supply and demand drivers, especially in Sydney. So, overall, banks are, on one hand, still wanting to grow their home loan portfolios as it remains the main profit driver, but lending momentum is slowing and underwriting standards are being tightened further at a time when home price growth is slowing. This leaves many households with loans now outside current lending criteria, households who are already feeling the pain of low income growth as costs rise. More households are falling into mortgage stress, and this will put further downward pressure on prices and demand. So we think the risks in the mortgage market are extending further. And the problem is that recent moves to ease momentum have come too late to assist those with large loans relative to income. As a result, when rates rise, as they will, the pain will only increase further. And that's the Property Imperative Weekly to the 30th September 2017. If you found this useful, do subscribe to receive future updates or leave a comment below. And do check back next week. Many thanks for watching.